Picture this. You're at a store, desperately seeking a rubber chicken. Maybe it's for a gag gift, a quirky decoration, or perhaps you just have an inexplicable fondness for rubber chickens. Whatever the reason, you're on a mission. Don't ask why, you just need it. You wander through the aisles, scanning the shelves, and finally, you spot them. There they are, two seemingly identical rubber chickens. One is priced at $10, the other, a steal at $2. You pick them up, examining them closely. They look the same, they feel the same. So why the price difference? Now you're no poultry-pinching Scrooge, but you're tempted by the bargain bin bird. You start to wonder if the cheaper one is just as good as the pricier one. This, my friends, is the essence of the price-to-book ratio. It's a tool investors use to determine the value of a company. In the stock market, companies are like rubber chickens. Some are more valuable than others, but sometimes the market misprices them. Just like our rubber chickens, stocks can be undervalued or overvalued. The price-to-book ratio helps investors figure out if a stock is undervalued or overvalued. It's like having a magnifying glass to see the true worth of a company. That's where the price-to-book ratio, or PB for short, swoops in. It compares a company's market price to its book value, giving investors a clearer picture. It helps us figure out if a stock is a prize chicken or a plucked dud. So next time you're in the market, whether for stocks or rubber chickens, remember the PB ratio. It might just save you from a bad investment. The PB ratio is a fancy way of saying how much are investors willing to pay for every dollar of a company's actual worth. Essentially, it's a measure that helps investors understand if a stock is overvalued or undervalued. Think of it like this. If you smashed a company to bits, figuratively of course, sold off all its assets and paid off all its debts, whatever's left is its book value. This book value is essentially the net asset value of the company. Now the PB ratio compares this book value to the company's market price. The market price is what investors are currently willing to pay for the stock. It's like comparing the price of that bargain bin chicken to the price of its rubbery beak-to-tail worth. If the PB ratio is less than 1, it means the stock is trading for less than the value of its assets. The formula is simple. Market price per share divided by book value per share. A lower PB ratio could indicate a potentially undervalued stock, while a higher ratio might suggest overvaluation. However, it's important to consider other factors like the company's growth prospects and industry conditions. The PB ratio is just one tool in an investor's toolkit, but it can provide valuable insights when used correctly. Let's say there's a company called Clucky Co, get it? Clucky Co makes, you guessed it, rubber chickens. Each share of Clucky Co costs $10. After some digging, we find their book value per share is $5. So we divide the market price, $10, by the book value, $5, and voila! Clucky Co has a PB ratio of 2. This means investors are paying $2 for every $1 of Clucky Co's assets. Is that a good deal? Well, that's where things get interesting. Section 4. High PB, low PB. What's the deal? A low PB ratio, generally below 1, could mean the stock is undervalued. It's like finding a diamond ring in the clearance bin. A high PB, above 1, might mean it's overvalued. Think designer rubber chickens. But hold your horses. Don't go buying up all the low PB stocks just yet. PB alone doesn't tell the whole story. It's just one piece of the puzzle. Section 5. ROE, the Robin to PB's Batman. Enter return on equity, or ROE. ROE measures how well a company uses its money to make even more money. Think of it as the company's profit-making superpower. A high PB with a high ROE might be okay. It means investors are paying a premium but the company is making bank. But a high PB with a low ROE? Red flag. It's like paying extra for a rubber chicken that squeaks less. Section 6. PB in the real world, from tech titans to toymakers. In the real world, tech companies often have high PB ratios. These companies are driven by innovation, constantly pushing the boundaries of technology. Their value is often tied to their intellectual property, such as software, patents, and proprietary algorithms. This means that even if they don't have a lot of physical assets, their potential for growth and profitability can be immense. They're all about innovation and growth, even if their assets are mostly intangible. Think software and patents. These intangible assets can be incredibly valuable, but they don't show up on the balance sheet in the same way physical assets do. This is why tech companies can have high PB ratios. Their market value is often much higher than their book value. Meanwhile, companies with lots of physical assets, like manufacturers, might have lower PB ratios. These companies are often valued based on their tangible assets, such as machinery, buildings, and inventory. While they may not have the same explosive growth potential as tech companies, they can offer stability and consistent returns. So, there you have it. The price-to-book ratio in all its rubber chicken glory. It's a quirky way to remember that not all companies are valued the same way. The PB ratio helps investors understand the underlying value of a company, whether it's a high-flying tech startup or a steady manufacturing giant. Remember, it's not a magic bullet, but it's a handy tool to have in your investing arsenal. By comparing the market value to the book value, investors can get a sense of whether a stock is overvalued or undervalued. It's one piece of the puzzle, but when used alongside other metrics, it can provide valuable insights. Happy hunting for those bargain bin birds. Whether you're looking for the next big tech innovation or a solid manufacturing investment, the PB ratio can help guide your decisions. So keep an eye out for those hidden gems and make informed choices in your investment journey.